And then there's the concentration risk that almost nobody's talking about. 7 stocks, the so-called Magnificent Seven, now represent over 30% of the S&P 500's total market capitalization. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, Tesla. If you own an S&P 500 index fund thinking you're diversified across 500 companies, you need to understand that your portfolio's performance is now dominated by just 7 stocks. If these 7 stocks correct, and by correct I mean return to valuations that are anywhere near historical norms, the entire market follows them down. This isn't diversification. This is concentration masquerading as an index fund. The AI boom that's driving these valuations mirrors almost exactly the internet boom of the late 1990s. You have revolutionary technology that's real, productivity gains that are legitimate, massive investment flowing into the sector, and stock prices going parabolic. Then you get a crash that wipes out trillions in paper wealth. The question has never been whether AI is real. The internet was real too. The internet changed the world, but that didn't stop internet stocks from crashing 78% because the valuations had become completely detached from reality. The question today is whether current stock prices reflect economic reality or collective fantasy. At 40 times cyclically adjusted earnings, I would argue fantasy is winning. When KP ratios have exceeded 30 for extended periods throughout history, markets have always, without exception, experienced corrections of 20% or more. At 40, we're not pricing in normal growth anymore. We're pricing in absolute perfection. We're pricing in a scenario where nothing goes wrong, where AI delivers on every promise, where earnings grow at unprecedented rates indefinitely, where interest rates stay favorable, where no recession ever comes, where geopolitical stability reigns, where nothing disrupts the current narrative. And perfection, as we all know, doesn't exist in financial markets or anywhere else. Crisis number 3 is what I call the debt doom loop, and it's the crisis that makes all the others harder to solve. $38 trillion. That's the current national debt of the United States as of this month. It was $36 trillion at the start of 2025. We're adding roughly $2 trillion per year in new debt, even during what's supposed to be good economic times. But here's the number that should terrify every taxpayer and every bond investor. $1 trillion. That's what the federal government paid in interest on the debt in fiscal year 2025. Interest payments are now the second largest line item in the entire federal budget, behind only Social Security. And ahead of Medicare, ahead of national defense, ahead of everything else we spend money on as a country. The Congressional Budget Office projects that interest payments will hit $1.8 trillion annually by 2035, but that projection is based on the assumption that interest rates will decline from current levels. What if that assumption is wrong? What if rates stay elevated or even rise further? Every 1% increase in average interest rates across the maturity structure of federal debt adds roughly $380 billion in annual interest expense. The debt doom loop works like this, and it's a self-reinforcing cycle that feeds on itself. High debt requires high borrowing to roll over maturing obligations and fund ongoing deficits. High borrowing puts upward pressure on interest rates because you're increasing the supply of bonds in the market. Higher interest rates increase interest expense on both new borrowing and refinancing of existing debt. Higher interest expense increases the deficit because you're paying more just to service the debt. Higher deficits require even more borrowing to fill the gap. And the cycle feeds on itself, getting worse with each iteration until something breaks. In 2026, the federal government will spend roughly $1 trillion just paying interest on money we've already borrowed. That's $1 trillion that doesn't build infrastructure, doesn't improve education, doesn't strengthen defense capabilities, doesn't provide health care, doesn't do anything except service previous borrowing decisions. And here's what makes 2026 particularly dangerous on the debt front. The debt ceiling was reinstated in January 2025 at $36.1 trillion. We've already blown past that limit. Congress will need to raise it again, which means another debt ceiling showdown, another period of political brinkmanship, another opportunity for markets to panic about whether the United States government might actually default on its obligations. Another credit rating downgrade is entirely possible. Moody's already cut the United States from its highest AA rating back in May 2025, following the earlier downgrades from S&P and Fitch. We're running out of runway here. The 2008 crisis was fundamentally triggered by private sector debt. It was mortgages, credit cards, corporate borrowing that went bad and brought down the financial system. The next crisis will be triggered, or at least significantly amplified, by sovereign debt, by government borrowing that has reached levels that are historically unprecedented in peacetime. And that's harder to fix, because the entity that normally does the fixing, the federal government, is itself the source of the problem. Crisis number 4 is the consumer breaking point, and this is where the theoretical becomes intensely personal for millions of Americans. $1.66 trillion in auto loan debt outstanding. The average monthly payment is $748. Subprime auto loan delinquencies have reached 6.65%, the highest level since tracking began in 1994. 1.73 million vehicles were repossessed in 2024, the highest number since 2009, since the depths of the Great Recession. 28% of all trade-ins are underwater, meaning people owe more on their current car than the car is worth when they try to trade it in. The average negative equity is $6,900. Nearly 1 in 4 underwater borrowers owes more than $10,000 more than their vehicle is worth. Credit card debt exceeds $1.1 trillion with average APRs above 20% and delinquencies climbing month after month. Student loan payments resumed after years of forbearance during the pandemic, adding another monthly obligation that millions of Americans had temporarily escaped. The average American consumer is, by any objective measure, tapped out. Here's the indicator that terrifies economists who understand consumer credit dynamics. Car loans are typically the absolute last payment that Americans skip before they start missing mortgage payments or defaulting on credit cards. Why? Because you need your car to get to work. Without the car, you can't earn the income you need to pay all your other obligations. The car payment comes first, even before food in some cases, because maintaining transportation is existential for most working Americans. So when car loan delinquencies spike, when repossessions surge, it means that consumers have exhausted every other option available to them. They've cut discretionary spending, they've stopped going out to eat, they've canceled subscriptions, they've maxed out their credit cards trying to stay current, they've depleted their savings accounts, they've borrowed from family and friends, they've done everything they possibly can, and they're still falling behind. They're at the end of their financial rope. Subprime borrowers aren't some marginal group that doesn't matter to the broader economy. They're the canary in the coal mine. They're the early warning system. When subprime borrowers start breaking under financial stress, it signals that the pressure is building throughout the system and will soon move up the income ladder to prime borrowers, to middle-class families, to people who thought they were financially secure. And right now, subprime is breaking at rates we haven't seen since 2008, since the worst consumer credit crisis in modern American history. Now let me show you how these 4 separate crises connect to each other and create feedback loops that amplify the damage exponentially. Because individually, any one of these problems could potentially be contained by policy responses, by regulatory intervention, by market adjustments. But together, they create cascading failures where each crisis makes the others worse, in a self-reinforcing spiral that becomes impossible to stop once it gets going. Commercial real estate losses hit bank balance sheets. Banks that suffer losses become more cautious, more risk-averse. They tighten lending standards across all categories, not just commercial real estate. They require higher credit scores, larger down payments, more documentation, more collateral. Tighter lending slows economic activity because consumers and businesses can't access credit to make purchases or investments. A slower economy means businesses aren't hiring or even laying off workers. Higher unemployment means more consumers default on their obligations because they've lost their income. More consumer defaults mean more losses for banks, which makes them tighten lending even further. The cycle accelerates and feeds on itself. Simultaneously, if stocks correct 20 to 30% from current levels, which is entirely plausible given current valuations, the wealth effect reverses dramatically. Consumers who felt wealthy because their 401k had doubled, because their brokerage statement showed big gains, because their home equity had increased, suddenly feel poor when those paper gains evaporate. They cut spending dramatically. They postpone purchases. They cancel vacations. They stop remodeling the house. Business revenues drop because consumer spending is 70% of GDP. Corporate earnings fall because revenues are declining. Companies respond with layoffs to cut costs. More layoffs mean more defaults. More defaults mean more bank losses. The stock decline becomes self-fulfilling as declining earnings justify lower valuations, which causes more wealth destruction, which causes more spending cuts, which causes more earnings declines.